Shares of Disney are moving after hours. CEO Bob Iger speaking on the earnings call just moments ago. Julia Borston will tell us what Iger had to say about the quarter. Julia.
Well, CEO Bob Iger opened the call with a look at the 21st Century Fox acquisition and how it will bolster Disney with both Fox's international reach and the right assets to help build the new direct-to-consumer businesses that Disney is focused on. Now, Disney shares first dipped after the numbers were released, but then they turned positive during the earnings call. It seemed like it was around the time when Bob Iger reassured that cord cutting is slowing thanks to the growth of digital bundles. Take a listen.
Although the erosion of the expanded basic bundle continues, the impressive growth of these DMVPDs has steadily slowed overall sub-losses. To that end, we've seen noticeable improvement in the rate of sub-loss in each of the last 4 quarters.
Iger also said that the Fox acquisition will help them in their various direct-to-consumer efforts, including Hulu and the Disney-branded app that's in the works set to launch next year.
In this era of unprecedented consumer choice, brands matter more than ever. And our incredible portfolio of high-quality, in-demand branded content uniquely positions us to strategically and successfully navigate this increasingly dynamic marketplace. We have always believed we have the brands and content to be extremely competitive and to thrive alongside Netflix, Amazon, and anyone else in the market.
As for the ESPN Plus service, which launched in April, Iger didn't reveal any numbers, but did say the initial performance is encouraging and that conversion rates from free trials to paid subscriptions are strong, with subscription growth exceeding expectations. Scott, back over to you.
Julia, thank you so much. For more, let's bring in the longtime media executive who served as CEO of Tivo for 11 years. Prior to that, Tom Rogers was NBC's former chief strategist who became the first president of NBC Cable, during which he founded CNBC. Today, Tom is a CNBC contributor, executive chairman of sports gaming and gambling company WinView. He joins us now. Welcome. It's good to see you.
Great to be here.
So that's a long and great resume. Is Iger going to get the last laugh?
Well,
and you know what I mean by that, because there have been so many naysayers. And here the stock is back at 117, a little north of that. Sub losses are slowing.
I think he's got a great opportunity to take a victory lap here if he backs off of Sky. The challenges that this company has with declines in their core business. Look, they're still losing subs. Advertising revenue on the cable side is down. The whole sports bidding area is going to get really tough with the FANG companies coming in. Now he's taken on trying to catch Netflix to try to learn the satellite distribution business, satellite dishes, set-top boxes, the whole deal, which, if you look at DirecTV and Dish's numbers here, even though Sky's in somewhat better shape, not the same story, but a difficult story, I don't get them needing to play that card.
Any plus in not spending billions of dollars on rights fees for sports, number one. Number two, legalized gambling has to be a boon for ESPN, no?
Well, now you're talking my game. I mean, that's my current company, and I don't know if they mentioned it. CBS mentioned it on their call. If you're in the sports business and you're seeing sub fees and advertising revenues decline, and you want to stay in the business of bidding on sports, there's one major new source of revenue that you got to get into, and that's sports gaming and gambling. And you got to figure out how to grab it before the other players do. I'm surprised that did not come up as a major issue for them. But the issue of whether he gets the last laugh, we're not going to know. This, chasing Netflix isn't just about buying Fox.
Market seems to like the Fox asset.
Well, the Fox asset.
Unless you think they paid too much.
Well, it's a great asset. And if they don't pursue Sky, you got a chance here of getting the Fox assets without, by next year, having any greater leverage on the company. That's a big win. Last laugh, good victory. But you got to understand that getting the Fox assets is the first chapter in a multi-chapter story about whether or not you can catch Netflix. First of all, Fox has a lot of its content tied up in HBO. Much of the Disney product is tied up elsewhere, not the least of which is if they don't get Sky, Comcast has a lot of Disney product caught up there. They got to figure out how to get through Hulu. They got to spend billions of dollars on more original content. What they're getting from Fox won't begin to really make a dent in a global Netflix franchise. Then you got the issues of the earnings dilution that all that spending is for an EPS measured company. This is something they're going to have to explain. Do you ignore those losses because you're building a new asset versus it being an ongoing drag? And then you got the issue of you got to continue to manage the decline in your core business.
Okay, so you've set it up absolutely perfectly for everyone here, right? Yeah. The business may be stabilizing, whatever word you want to use. Stock is up. Technically, it seems to be in a good place. But as Tom says, the risks are still out there for this name.
Well, it's interesting to hear Tom talk about the amount of money that they're going to have to spend on content to keep up with Netflix's global franchise. Because that, to me, is an extraordinary statement in that I always thought it was Netflix chasing Disney. I always thought it was Disney with the best content. Bottom line, I think Bob Iger has a more diversified company here. Disney is not just, it's a consumer products company. It's a studio. It's obviously the cable, which is in a difficult place. But I think Disney is doing interesting things in terms of getting to that broader demographic. They were broadcasting this Overwatch over the weekend. In other words, they're getting into gaming and younger sports and how people are consuming that. That's interesting.
Chasing scale is a loser's game. I mean, I look at it and say the investor base in Disney right now is, I'm not saying it's a different investor base than Netflix. I think it's probably some of the similar investors, but ultimately, you've got a company right now that is going to have to spend so much to chase Netflix. So much. It's going to cost them a fortune, going to impact margins. They're coming off a really successful film slate. I get they have great content.
It's all about scale, isn't it?
Chasing
scale's a loser's game?
No.
Not chasing it in the media business right now is a loser's game.
I'm saying you chase it, but it's going to cost you a lot. It's going to cost you a lot. That's going to impact margins.
There's a victory lap here that they should take on the studio side, though.
Isn't it early, though, to take a victory lap? I mean, anybody can pay for anything.
Well, before they get to paying.
Oh, you mean before the
studio,
okay.
11 days, the Avenger film, taking in $1 billion, the kind of market share they have, getting through the Justice Department with the Fox studio, getting over 50% share in theatrical production without anybody raising an eye at all on that. You got to give them a big victory on that one.
That's the question. Is that sustainable? I mean, you look at their pipeline and say, is that going to be a sustainable sort of like aspect for them, or are they able to sustain those sort of numbers?
It may be. They've shown unbelievable acquisition capability with Pixar and Lucas and Marvel. They've really done tremendously well. Can't take a thing away from them on acquisition of studios, and Fox will only continue to drive that, I think. The problem is, to your point, it's not enough. To play the Netflix game, the amount of incremental dollars you have to put in programming is so far beyond this investment, which is why I think, geez, do you really want to tie up a bunch of cash in Sky and have to manage the decline of that business when you could go home and save your resources for the game you're really going to need it for?